Let's get into housing, and specifically we talk about the housing shortage and how that's impacting the rental market, which is extremely tight at the moment. Let's get into that. Anthony Landahl joining us from Equilibria Finance. Anthony, good to see you.
Great to be here.
So, in fact, I know a lot of people trying to look for a place to rent at the moment. It is incredibly difficult, so competitive because there's simply such a shortage at the moment. Are we seeing any resolution to that? Is it only getting worse?
It's getting worse, to be honest. I think we read a lot in the newspapers. I did a little bit of work recently just looking at actually what's going on in some of the data, which is quite interesting. It sort of highlights the starkness of it. For example, in 12 months to February, the combined capitals rent's gone up almost 15%. The regionals is around about 10% on units. On houses, the combined capitals is up around 10% and the regionals are about 7% in rent. For example, in Sydney, to put an actual number to it, its unit increase has been about 16.7%, which represents about $394 a month increase in rent people are paying. So it's an incredibly tight market. There's particular patches as well that are really getting impacted. Inner city Melbourne, for example, its rental's up about 41%. And there's other areas, regional Queensland, Ku-ring-gai in Sydney's north, they're up around 20 to 30%. So there's a real, the numbers are telling a story that there's a real increase going on in terms of the rentals. For example, the combined capitals before COVID, compared to before COVID on units is up around 19%, and that's pretty stark. And vacancy rates are under 1% on the whole. In fact, in Adelaide, they're at 0.2% vacancy rates.
So what are driving these rental prices at the moment is the two factors, I guess, where you've got obviously that supply-demand dynamic, where demand is incredibly high at the moment and there is a shortfall, but also landlords themselves having to increase those rents to cover their own costs.
Yeah, look, the main driver right now is essentially there's an acute shortage of housing. We're talking about 650 to 900,000 foreign students and skilled workers coming into the country, and housing starts are below $100,000 per annum for the first time in 10 years. Those numbers don't add up. So there's an acute shortage of housing. There's a couple of other factors. Obviously, the cost of funding has gone up for investors. Investor credit flows are down 30%, so there's actually less properties becoming available on the market. But the main driver at the moment, and you said it, it's basic economics, is supply and demand, and there's just an acute shortage of housing with no foreseeable solution on the horizon. There's some longer term prospects out there. Obviously the federal government's looking at some social housing initiatives. They're in 24, 25 budgets. We're also seeing some foreign investment in rent to buy programs. Mitsubishi's just invested in a $5,000 unit, a 5,000 unit block, but those projects are on the horizon, and we're looking at an intake of 650 to 900,000 foreign students and skilled workers over the next 2 years. We don't have the infrastructure, and essentially there's a shortage of housing. And as I said, the building approvals or the housing starts is the lowest in 10 years, falling below $100,000 a year for the first time in a decade.
So when we take a look at investors perhaps solving the solution here, well, it's not going to be short term, is it? You just said that, because a lot of these projects, if you've got to actually start building, that's obviously long term. And I guess, what are you seeing with investors at the moment, given those tightened lending conditions? Yeah,
investor credit flows are down 30%, annualised numbers. So we're not seeing a pickup in that right now. A lot of investors have been sitting on the sideline. I think opportunities are coming for investors. One factor is, one of the biggest factors for investors in cash flows, and we're seeing the rental yields we've just been talking about at record levels. Cost of funding has gone up, but investors are able to take obviously advantage of the tax benefits and gearing. So I think we are seeing opportunities in the next 6 or 12 months for investors. We just haven't seen that starting to flow through yet.
Do you feel with the possibility the RBA could pause next week and even possibly cut by the end of the year, that would be a green light for investors?
I think investors are waiting for some stability from the RBA, and also they're just trying to gauge the housing market separate to the interest rates. We've seen a bit of a slowdown in the housing market. In fact, last month, Sydney's market rose again. So I think investors have just been waiting for a little bit of stability. But yeah, I think a pause in the rates will help settle down investors as they look at coming back in the market. I think they've also just been waiting to go, okay, where's the bottom of the housing market? Where are the opportunities now to then capture that growth as the market comes out of where it's been over the last 6 to 12 months?
Are there any other short to medium term solutions for that rental shortfall, such as repurposing office blocks, for instance? I mean, that's a costly undertaking, but we were talking just before we came on air, the fact that there are sort of office towers around that are still half empty at this point.
Yeah, look, they're going to have to work out some solutions. I mean, it's essentially supply and demand. So they've got to either look at the numbers of students and workers coming in. Can we actually cope with that in terms of infrastructure, roads, housing, public hospitals? And then there's where are the initiatives coming? Whether that's looking at repurposing buildings, whether that's looking at loosening up some of the restrictions and opening up more blocks of land where people can build, whether it's giving more incentives to foreign investors for some of these rent-to-build projects. There needs to be some long-term planning. It seems like suddenly we're going, look, we got another 650 to 900,000 foreign students and workers coming in, but where's the long-term plan saying this is on the horizon and this is how we're going to accommodate and house all of those people as well?
So we're talking about those tight lending conditions making it difficult in the property space. Beyond property, you're also dealing with small businesses. Are they feeling it at the moment in terms of difficulty to borrow, or in fact a reluctance to do so given where we're at the moment?
It's a little bit of both, to be honest with you, Andrew. There's the cost of funding has now flowed through to small business, no doubt about it. We're seeing more demand from small business around cash flow funding, which is essentially I need to fund the short term of the business. There might be a differential in when they're receiving payments and when they bill, when they're billing payments, or it might be they're paying their staff waiting for funds to come in. The other thing is we are seeing more rigour from credit providers around releasing some of the funds and for what purpose they're for. Probably the big change we've seen is there's less activity from small business around investing in their business. They're very much focused on, I guess, waiting and seeing where these rates go, waiting and seeing where inflation goes. And there's some businesses where their discretionary demand might be based on discretionary expenses that are probably starting to feel the pinch, as we saw those inflationary numbers fell in February, which is a good sign in terms of where we're trying to get to, but that's presupposing that consumer spending is easing. That's going to start flowing through to some small businesses as well.